in the 80s, life insurance was, how do I put it, banging when it came to putting cash value into a life insurance policy. Why? Because you could basically put as much cash as you wanted into the policy. And insurance policies were regulated in the same way as retirement accounts, that you could get the same advantages of tax deferral. I'm going to go over that a little bit more, but first I want to jump into what happened when the IRS stepped in and spoiled the party in 1988 by enacting the Technical and Miscellaneous Revenue Act. What that act did is it actually created 3 criteria regulating how much cash could be put into a life insurance policy and still call it life insurance. The act was also bolstered by the IRS Code Section 7702, in which Congress also prescribed how much money could go into a life insurance policy. Basically, the 3 criteria are somewhat straightforward. The first one is it life insurance? And that one's easy to figure out, as well as the second one, which is really whether the policy predates 1980. The more complicated one is the 7-year rule. The amount of premiums paid into the policy, if that amount would exceed how much it would take to pay off the policy in 7 years, then that's how a MEC is determined, simply by a formula. Next question is really, what's the risk? A lot of people get really worried about their policy becoming a MEC, and typically most companies are monitoring policies on a monthly basis. Typically then, if it looks like a MEC is going to occur, the insurance company has 60 days to send the excess premiums back. The next question is, what if a MEC does occur? Are we really concerned about that? There are some circumstances where a MEC is okay. For example, a single premium life insurance policy where somebody is exchanging a pile of cash for a much larger death benefit. But what's the impact of a MEC to a life insurance policy? You're really losing the couple things. The tax deferral benefit, in other words, as income occurs, that's deferred in a life insurance policy, not so in a modified endowment contract. With life insurance, if you remove cash from the policy, a first in, first out approach is applied. That would mean that you're not paying taxes until the amount that you take out exceeds what you put in terms of premiums. If you lose that and you end up with the last in, first out, then you're going to be taxed on that immediate dollar coming out of the policy. So cash value, long-term wealth building policies may be much more impacted. With that in mind, we'd love it if you'd like us. Subscribe to the feed. We're going to have a lot of these topics coming out. Click the bell for notifications. We will see you in the next video.